Good afternoon, everybody. Welcome to the Trader Merlin Show. It is your FOMC Wednesday afternoon. An afternoon that didn't see much of a surprise, although we will talk about what the markets did. And before we get to that, I need to apologize to some of you. I know some of you were in the digital assets program today. For some reason, it wasn't on my calendar. And by the time Todd alerted me to it, it was already like 10:47. So I did do a full session this morning. It was just 1 hour late. So my apologies for anybody who may have been in that room, but there is a recording of it. We did do a 1 hour session. I won't make those mistakes again. It happens. I'm having my senior moments. As we get older, this stuff starts to happen. But for some reason, it wasn't on my calendar. I'll blame somebody else, but no, I'll take the credit. Anyway, it is the the 18th of December. We had, as my graphic showed you earlier, or I guess you saw the thumbnail for today's show, the final rate cut of 2024. Now, of course, this is a question mark because who knows, there could be some surprise between today and the end of the year. But right now, I think that this will be the last one for the year. And here to help me break it down is my resident bond expert with over 40 years in the bond markets. We've got Mr. Bill Addiss joining us. Bill, how you doing, my friend?
I'm doing great. Also had a senior moment today, so we're both in good company.
It happens. It happens every now and again. We're okay right with senior moments. The year's coming to an end. Last year, I'm starting to lose track of time, honestly. I think that last year, at the end of last year, they were saying, was it 8 rate cuts by the end of this year?
That's correct.
Yeah.
8 cuts. That's it.
Well, we got 3. Was it 3 or 4? 3 or 4.
We had 3. One was 50 basis points, so
And
it's a
then
total of 1%. Right. So we got 1% and 3 rate cuts. And the expectation next year is the more important. And I think that's what the equity market's reacting to, because today's event was a non-event, right? We got what we expected. There was absolutely no surprise. It was just a question of where Powell was going to put an inflection or burp or hiccup or wink during the press conference. And he did disappoint the market by when the dot plots show that for next year, the members are looking for only 2 cuts. We went from 8 to 4.
I will let me bring that one up. So I do have the dot plot here. I'm going to go through your charts in a sec, but here's the dot plot for those of you who may be interested in what Bill was just referencing. You can see here we've got the bottom 2025, 2026, and 2027. And you also have the September meeting is like purple, and then the December meeting is like a dark blue, I guess. And you can see that the 2025 numbers, it actually looked like a lot of them have jumped their expectations up. You see that everything kind of lifted up here for 2025. This, I think, is probably what spooked our market today. Would you say that was a big piece of it?
Absolutely. I mean, the market, until that news came out, the market really hadn't reacted at all. It most definitely is. And it kind of begs the question, and I'm not trying to be sarcastic, but if you're looking at the plots where they're looking at the economy getting better and inflation starting to become, certainly not going away, why did they cut? What was the purpose of today's cut? I almost think they felt pressured by the market that they had to cut because they telegraphed it so much.
Yeah. I'm in that camp too. For the viewers out there, I'm curious. Type in the chat, why did you think that they cut today? And again, there is no real right or wrong answer.
Right.
At this point, I think what Bill's mentioning is they did telegraph it. And I think it all starts with that 50 basis point cut. And a nice, calm, everything is okay. Let's test out 25. And then we do another 25. But to me, that 50 was this, like, what the hell kind of moment. Like, why would you need to cut 50 basis points when every metric you have is showing that things are okay, inflation is coming down, the other economic data looks good, and now all of a sudden we're cutting again and again and again. I think that there's a lot of analysts out there that have this wrong. And I talked to you about this right before the show. I can't remember his name, but I was listening to something about Jerome Powell's speech, and this guy was saying, look, I don't think that there's any real problem going forward with inflation. And the host says, well, do you see them cutting rates more next year? And he goes, absolutely, I see aggressive rate cuts. And she again brought up inflation, and he's like, no, there's gonna be no problem with it. And maybe I'm missing something, Bill, but if you cut rates back down towards 0, that is a catalyst for inflation. If you print more money, it's a catalyst for inflation. And we still already have inflation that's higher than what Jerome Powell said he wanted. And he even said at the press conference today, it's not acceptable for us to keep that above where we want it. We're going to get it back to our target. And I have to scratch my head going, well, how do you expect to get it back to your target of 2% if you're cutting rates and you're going to have a new Secretary of the Treasury in January who is going to say, I want a weaker dollar. Let's print more of it. I feel like I'm not understanding what's going on here.
There's a disjoint. No, you're in good company by scratching your head. We all are, because there's a disjoint between what they're saying and what they're doing. I mean, if you listen to Powell's conference, you wouldn't come to the conclusion, well, of course they cut today. It would kind of be a validation for being on hold. No, I share. I really think the Fed kind of felt pressured into doing it, and it's almost like they pressured themselves. And this kind of, not to get too philosophical, but this kind of becomes an issue of just how much transparency should the Fed be affording us.
Yeah.
As you were saying, we're making forecasts out to 2027. I mean, the market was down today by almost 3% because not of what the Fed did today, but because of some forecasts going out for a year. I mean, is not to get too philosophical, but is too much data a problem? Or too much transparency a problem?
It's funny. It's that double-edged sword of we want transparency, we want to know what's going on. I personally don't. I like the Greenspan days. I know I wasn't much of a trader back in the Volcker days, but I love the surprise. Like, did he just cut 50 basis points? Why do my charts look so crazy? Because he just had no clue what happened. I love that type of stuff, but it also poses a bit of a market hazard. So I do think the transparency is good, but I think some of the comments here, Fury says, felt pressure, shouldn't have cut today. That was the last inflation report. Steve says, because it was already baked in. Yep. It's always the commentary that moves the market. True. And today was, 99% baked in. I think the FOMC Fed Funds Futures thing was telling us that as well. Now, I do want to go and look here because from what I'm hearing from the market, they're pricing in more rate cuts next year. The dot plot, which I'll bring back up here for the viewers at home, paints a slightly different picture. Here is your dot plot. And they're saying by 2025, if we are currently sitting at 4.75, 4.4 to 4.5, then we would be looking at it looks like 3 rate cuts because expectation appears to be right around 3.85, 4% for the end of 2025 based off the dot plot.
Right. And that's, 1 to 2 cuts. That's it.
Yeah. And here I will show the viewers what the Fed Funds Futures are pricing in.
Yeah. There you go.
They are pricing in right now a 25 basis point cut. 1 cut by the end of the year. Of next year.
Really?
Yeah.
Really?
Yeah. 2025 December meeting, they're saying 4.25 to 4.5. Which is where we're at.
I will tell you, I don't know what it was yesterday, but I'll tell you, going back about 3 weeks ago, the futures markets was pricing in 2+ for next year, 3, and even at that, people thought it was not aggressive enough. Remember,
right? If you go back a week ago, you go to December 11th, there was a 31% chance we were going to see 3.75 to 4%, so a full percentage point cut. Yeah.
Yeah. Right. Wow. Yeah. What a difference a day makes, huh?
Yeah.
Who says the Fed can't move markets?
Yeah, we know they move markets. This is why today is always, that Wednesday, guys, is always such a wild card. You just have to be very, very careful out there. And, if you watch the chart of today's activity, I'll bring it up here on a 5-minute basis. You can see when the number actually came out, 11 o'clock right there. So we dropped, and then really the free fall started at the press conference, right? There was that knee-jerk reaction, and then it was like, oh, my goodness. And I think Big Eb mentioned earlier that, sometimes Jerome Powell can say something that the market just perceives how they want to perceive it, and it just tanks the market. Now, if we look at the big picture here, today you had a 3.05% slide for the S&P. Look, so what? We erased a month worth of trading.
I was going to say, that's on top of 57 record highs this year, guys. Come on. Yeah. When people say, why was the market down today? My question is, why was it up for 57 record highs?
Yeah. Yeah, this is it's an interesting chart because today's candle obviously looks just monstrous and ominous and just evil, but I mean, big deal. We're still on a huge uptrend. This trend that started back in August, just that small segment of it. I mean, fine, keep on moving. I'll take these types of pullbacks all day long in an uptrend when the uptrend is market moves up 30% and drops 5%. Okay, fine, I'm fine with that.
Yeah. Yeah. No, equity showed a lot, but I have to be honest with you, being my bond guy, we saw a lot of volatility on the bond side this afternoon. It's fascinating to me. Talk about volatility. So here's the Fed bringing short rates down by 25 basis points. Meanwhile, the long end of the market went up by 11.
Yeah.
We're seeing huge volatility once again. The yield curve, we don't have an inversion anymore. The
Eh.
inversion is gone. It's officially declared dead.
We can end that discussion on the inverted yield curve. So, okay, so we've got so many different tracks I could go down here, but if you talk about the inverted yield curve, we're officially out of it. Now, you are much more, I believe, a student of this historical aspect of the market, and that is when we have an inverted yield curve, there's always a recession somewhere, right? It's always around that corner.
Right.
How long typically does it take? When we go into a recession, has the yield curve already inverted or returned to normal?
Yes.
Typically? Okay, so we still could
great.
potentially have that recession ahead.
We could, but the time frame I think is so long now that we can let the Fed take a bow. And what I mean by that is, of the 7 prior inverted yield curves we've had, the longest period of time it took to get into a recession from the time the inversion started was 14 months.
Oh, we're way
and in
past
some
that.
cases it was exactly, and in some cases it was just short of 7. So here we are at 20 months, still no recession. I mean, GDP projections for next year are 2 plus. And if you think about it from an interest rate cycle, right, with the pandemic, the Fed brought the rates down, brought them back up again, now bringing them back down. So they've gone kind of, you could call it full cycle. We're now at 20 months. We've no recession in sight. I think the Fed can take a bow here. I think they achieved the magic soft landing. I really do.
Bill, bite your tongue. Bite your
I
tongue. We're not,
know.
Bill. I'm gonna have to
And
kick you off.
Yep.
Okay, so
I
I know.
can't believe I'm saying it.
So Bill teaches for the Fed. So I think there might be some window dressing going on here. But how can you take a bow if you have said we want to get inflation under control and 2% is that target, right? And you didn't achieve that target? To me, that's not a success. And I'll give you an example. When I went to college at Sacramento State, I was giving money from my father, who got it from grandma, and said, "Here you go. Here's your room and board and college tuition." I got there with no money. I joined a fraternity, where I actually rushed fraternities. I never paid for anything. And next thing you know, I'm more drunk than I was sober in my college freshman year. And I got a 0.69 GPA, to which my father says, "Hey, at least you got a good number." So he told me, he says, "Listen, you've got to get a 3.0 GPA or I'm not paying any more money at all." So of course I got my acting gear. I had a goal to get to. That's when I would take a bow if I got over 3%, 3.0. I got a 2.87 GPA, at which point my father said, "You're on your own, son." And ever since then, I've paid for every single thing myself. Long-winded story and way too personal. But if the goal is 2% and you haven't hit the frickin' number, how can you take a bow? You haven't done what you said you were going to do.
True, but I don't disagree with anything you said. But I would like to point out, the Fed has got this magic fine-tuning act they've got to do, right? Between raising and lowering rates, the mandate the Fed has of price stability and full employment, by its very nature, is contradictory. So the Fed always has to choose one. Which are we going to do, right? We're going to focus on the economy, or we're going to focus on inflation. And they have to do this balancing act. And what I'm saying is, after 2 years of that balancing act, we've had the inverted yield curve, which, is a function of market conditions, but we don't have that dreaded recession. So relative to that recession discussion, I think the Fed can take a bow. Do I agree that they haven't done things perfectly? Of course. I mean, remember back in the days when they refused to acknowledge inflation was even in existence?
Yeah, the transient thing, right?
Inflation at 5% and Powell saying pay no attention behind the screen.
Right.
So I'm not saying they haven't been slow at times. Maybe they were preemptive with the 50 basis points cuts. I agree with you on that. But hindsight is 2020.
Right.
But the bottom line is they've gone 2 years, and by every metrics we've had historically, they should have pushed us into a recession, and they managed to avoid that. Now, is the penalty for that? Maybe inflation is a little bit higher than we'd like to see it. Personally, I'd take that as an offsuit, a 2.6% inflation rate rather than 2%,
Yeah.
for the sake of keeping the economy running along smoothly. Personally, I'd accept that.
And I agree. I'm playing devil's advocate here. I do think.
I know.
Look, you got it down into twos. For me, it's like fine.
Right.
You said 2%. It is 2% technically, right? 2.6, 2.4. It's fine. So yes, I agree. I think that they should be happy with what they've done. I think we could be in a far worse situation. My only concern is that we saw inflation slow down, and then all of a sudden now it's starting to increase a little bit. And I believe we haven't even felt the impacts of these last, 2 rate cuts and now a third rate cut.
Right.
My concern is that this will be a big talking point in 2025 is the inflation issue, particularly when you start slapping tariffs on, weakening dollar, lowering interest rates. It's like you've got a perfect trifecta here, which could really get us back into the 4 or 5%, which might work great for your I bonds, but not so great for the economy.
And I share that concern. And I'm going to add the other one, which is being the Keynesian kind of guy that I am. We still got all that money sloshing around in the economy.
Yep.
We've still got a huge amount of cash out there. And the tariff policies, not to get political, but, as you said, for your audience, what the Fed does today, they really estimate impacts the economy about 6 months from now. So if we, as you said, so if we talk about the Fed started cutting rates back in August, September, the impact of that is just going to start being felt, which should be to boost the economy a little bit. That's the whole reason they did it. So take that economic activity boost, which we're hoping for, but add on top of it the tariff and inflationary pressures of that and all the money in the marketplace. I'm starting to depress myself.
Yeah. Well, the one thing I keep telling everybody is it doesn't matter whether you're politically positive or supportive or anti this current and next administration. Bottom line is we got to deal with it, and I'm kind of positioning myself for more inflationary going forward. We'll see how that goes down the road. For the viewers out there, yes. That was a horribly low GPA. I was partying more than I was studying. And it was actually the best thing that ever happened because ever since then, I've been paying for 100% of everything, including all my rent, my insurance, college, books, everything. So, I thank my dad for that. I wonder what he did with all that extra cash, but that's on him.
Full of tough love. That's the hard one.
Yeah. It's funny. You see I live in Southern California where you get some kid who just turned 16 and daddy's like, oh, here's a brand new M3 and, here's a Bentley. It's like, my first car was a beater, man. I was lucky to even have one. So obviously we know the front end 25 basis point cut. Was there anything in there that, brings down other rates or other metrics that might be noteworthy for everyone here today?
Thank you. Because there's one actually that's going to impact the audience more so than any other. So the Fed brought down a bunch of different rates today. The first and the most important is that Fed funds rate, the interbank rate. They also dropped the discount rate. That's the rate that banks can borrow from the Fed. But the third one they dropped, which is going to impact your audience, is and I'm going to get eco-nerdy for a moment. It's the reverse repo Fed lending facility. Now, what that means is what your money market funds have been doing. If your audience has a money market fund anywhere, sweeping their credit balances, giving them some interest earning, the money market funds have been ponying up to do this trade with the Fed, where the Fed has basically said to large asset managers, pension funds, insurance companies, we'll hold on to your cash. Literally, we'll pay you to do nothing with your cash. Just let us hold it. And they did this as a tapering tool. They were just trying to get that cash out of general circulation. So this was something they introduced during coming out of the pandemic as a way of trying to sop up some of that money we've been talking about that's been floating around. And the money market funds have taken great advantage of it. I mean, in my focus class, we looked through the Schwab and the Fidelity money market funds. They each had more than 35% of their total assets were invested with the Fed in these trades. So it was very popular. And what it meant was, as your audience knows, we finally started earning some interest on our money market funds.
Right. Yeah.
After zero for so long, finally we got up to 5+. And you can thank the Fed for that. Well, just like they've been bringing down the Fed funds rate, they've also been bringing down that interest rate. And they brought it down even more today. So whereas every other interest rate, they only brought down by a quarter, this repo lending rate, your money market rate, they brought down by 30 basis points. They made it less attractive, generally speaking. And that's also the Fed saying, we don't need to sop up as much money. We don't have to pay extra.
Right.
Remember, the Fed's a corporation. It wants profits.
Yep.
We don't have to pay as much to borrow that money. So what it means is we're all going to wake up on Friday morning and our money market funds are going to be yielding 30 basis points lower.
Yeah. Well, I mean, it's funny because I have an Ally account and I keep checking because when I first started with this Ally, I just keep some cash over there. It was at, I want to say 4.6, 4.7% just for normal savings. Great, right? No CD, anything, and now I think it's 3.8. It's been slowly trickling down, of course. Like you say, Friday I'll be earning 25 basis or 30 basis points less on that one. But, that's fine. I'll earn extra interest elsewhere.
There you go. There you go. But it's been nice having our cash earn us some interest for a while.
Absolutely. When we look out at the long end of that yield curve, you mentioned that we had a pretty significant up move today, and here is the 10-year bond for everyone. We're up 2.84% or 12 basis points on this one. 4.5%. I had made a wager with one of my viewers out here, Big Eb, that we'd be below. We wouldn't go below 4% for the year. Well, I lost that bet in early August when we dipped below there. I think that's when I did it. But now we're screaming to the upside, right? We've seen this last 2 weeks very aggressive. We've gone from 4.14, currently at 4.5. So we're talking about 40 basis points, almost 50 basis points in a short window of time.
Yep.
If we keep on shortening the short end of the yield curve and pulling that down, as some people are expecting, that should have some impact on the 10-year, but it's not, right? We're seeing that yield continue to surge. Why do you suspect we're seeing that 10-year continue to be so strong?
Great. And are you able to cue it up, the slide I gave you with the blue and red curve? That would be a great visual for this discussion.
As they said in theater, I can do anything. Okay. There you go. Today's yield curve. So what you're looking at here, the blue line that you're looking at is the yield curve before today's announcement. So this is pre-Fed. Now the red line is where the yield curve was on January 2nd at the start of the year. So we're capturing the full year here. So a couple of quick observations to make. Number one is you can see we had huge drop in the short end of the market. Thank you to the Fed, right? Mm-hmm. They dropped short rates by 75 basis points. But you can see what I think is at the 3-year point, yields 3 years and greater have gone up. And this is the point I'm always stressing with the OTA community, is yields are not linear. They don't move in a linear fashion. The yield curve is dynamic, my yield curve dance. And what we've seen over this last year is two things going on. Short rates coming down, thank you to the Fed. They own it. They own the short end of the market. Long rates during that same period have gone up. And there's really two primary factors for that. Number one is, and these are not new factors, you're going to recognize these, and then the audience will. Number one is, as we've been talking about, there is a growing fear of inflation. I mean, that's what our conversation today is about. That's what even was being acknowledged. Now, with the fear of inflation, that puts upward pressure on long-term rates. Because in an efficient market, if you think inflation is going to be more of a problem, you want to be compensated for that inflation. So time value, term premium, as they call it in bond talk, goes up, goes positive with the growing prospect of inflation. That's what we've been experiencing. And the other problem comes down to good old supply and demand 101. We're still having virtually unprecedented amounts of treasuries being sold off. Because up until for the next 4 months, we have a really abnormal amount of treasuries maturing. For the last 6 months of this year and the first 6 months of next year, the Treasury has a really absurd amount of treasuries actually maturing. 40% of the entire Treasury market was maturing within that 1 year period. But when a Treasury matures, we have to issue a new one to replace it because the government doesn't have the money to actually pay it off. Right. We just roll it over like a Ponzi scheme. So with all of these short-term treasuries now maturing, now they might have been issued 30 years ago as a 30-year, but they have a 1 year maturity now. Right. So we've got all these short-term treasuries are maturing and they're being replaced with longer-term treasuries. So we're putting an unusual amount of supply in the market. And on top of it, our elected officials and their love of deficit spending at record levels and the 1.4 third largest deficit we've ever had, having to finance that, we got a boatload of treasuries coming into the market. And it's simple supply and demand 101. More supply lowers prices, which means yields go higher. So for the next couple of months, I don't see either of those pressures abating. They're going to continue, which is, on your program last year, we had last month rather, or 8 weeks ago, when we did our Fed meeting last time. I said then, and I still say today, I think we're going to see 5% before we see 4%. I got a little nervous when we got down to a 4.15. Yeah. But I think 5 is in our scope much more than 4%. And it's interesting when you look at, you mentioned that, they're issuing these bonds, obviously to pay for debt. And then once they mature, it's like, okay, well, that debt's not gone. It's there, and it's increased significantly. So not only are you getting the issuance of bonds to cover the ones that matured, but you also have this new issuance, this exponential curve that's getting bigger and bigger. So that flooding into the market of these bond products, if you have the buyers for them and people are just ravaging for your bonds, then great, you can pay low yields. But if you have maybe some concerns about the U.S. economy and the buyers aren't there, then you have to offer a more attractive yield. Now, you'd mentioned this in the past that two of the biggest buyers used to be China and Japan. I've heard more rumblings recently about the Middle East and Saudi Arabia being also a major buyer. Has that dynamic shifted? Do we have the buyers for these bonds, or is it still kind of, hey, we're looking for a buyer?
No. Great question, Merlin. And the buy is God, I get so excited about this. I can't talk.
I love it.
Calm down, Bill. All right. So the buyers who's in vogue kind of changes over time. So what you remember was during the 90s and 2000, Japan and China were some of the biggest buyers of our bonds, and they were number 1 and 2. But even back then, Saudi was number 3 and Kuwait was number 4. Now, what then happened during the pandemic, and even prior to that, Japan and China pulled back. They weren't as big of buyers because they didn't have as much trade going on with the U.S. See, most of this is based on trade. So their amount of exports to the U.S. was down. They were buying less treasuries. But that's when the Fed kicked in. Remember, during the pandemic, the Fed bought 40% of the overall market. So you had the Fed being in as the big buyer. And now, as we sit here today, even today, the Fed owns 4 times as many treasuries as China and Japan put together.
Wow.
I mean, that's just incredible. So they own about a quarter of the market now. So China and Japan were replaced by the Fed. Now the Fed has disappeared. China and Japan aren't the big players they were. That's moving Saudi and Kuwait up the list, if you will. So the players aren't really changing. They're just, the scorecard is changing as to who's on top. And Saudi and Kuwait, if you got a moment, because this is my nightmare scenario. I don't know if you want to go here.
Oh, wait a minute. Us talking nightmare scenarios? Yeah, right. I'm getting excited. Bring it on. I spent this morning in one of my classes talking about a nightmare scenario in the in the digital asset space. So I want to hear yours. Come on, make me happy.
Right, here we go. All right, mutual Prozac. Here we go. So why were Saudi and Kuwait such big buyers? And by the way, again, in full disclosure, both of them are clients of mine. I do business with both governments. The Saudi government, all right, was a big buyer of treasuries because they sell oil. Same reason Kuwait was a big buyer of treasuries. I mean, understand, under OPEC, as you all know, it's a dollar-based system. No matter where Saudi or Kuwait sold oil in the world, they got paid in dollars. So what the Saudi and Kuwait government were doing is they were simply taking the dollars that they got from their oil sales and saying, we want a safe, liquid, long-term investment for our dollars. They weren't making a political statement. There was nothing. It was simply that we have dollars, let's invest dollars. So as a result, the Saudi and Kuwait have just under about 2 trillion, just a little bit less than China and Japan put together. My fear, and I'll get to it, is what happens when OPEC starts selling oil in other currencies other than dollar. I mean, understand, OPEC was created, 55 years ago? Because the U.S. was the largest consumer of energy in the world. It was created to feed us energy. I mean, that's why it's a dollar-based system. Jump forward 55 years, we're now a net exporter of energy. If OPEC were to create a new system today, it wouldn't be dollar-based. We're just living off the legacy. So what happens when OPEC starts doing sales in other currencies? Now OPEC will have baskets of rupees, have baskets of euros. They won't have to be buyers of our dollars. I mean, we've been very fortunate, for all the treasuries we have to sell and all of the supply we put in there. We've been very fortunate to have enjoyed very good demand for those treasuries historically. I'll be the first to admit it, right? 2.5 times as many buyers as we have treasuries usually. Please don't take that as a guarantee it has to continue that way. And what scares me is my nightmare has been realized this year. OPEC is now doing trades in local currencies. They've done 200 billion in rupees. And now OPEC is now enjoying rupee income. They'll be buying rupee securities rather than dollar. If this gets more widespread, we're going to have a problem.
Yeah, and at what point, I think part of that whole cycle, which has kept the dollar as this reserve currency for the world. I mentioned this a few times in presentations I've done over the past couple of months, which is, what gives the government the power? And it's the ability to control the money. And then what gives them the ability to control the money is we have the largest military in the world. So when you look at a country like Saudi Arabia, which obviously has plenty of money and wealth, to what extent have they been pressured into sticking with the dollar because of U.S. support, U.S. might, U.S. kind of dominance in the world? And do you see that eroding? Because now you're hearing about BRICS coming up and more unification of other countries that may ultimately, compete with the U.S. dollar. And I'm a believer that OPEC and Saudi should accept whatever payment they want. It's their oil, If you want to pay for my house with Bitcoin, that should be my choice, whether I want to take euros, yen, pounds. I'll take whatever I want because it's my asset. I'll sell it for whatever I want.
No, I have to agree with your point. And in terms of the Saudis, we can't deny the military and political implications. I mean, let's not be naive. But also, money seems to talk. Yeah. I mean, understand the Saudi government, with the oil where it is now, the Saudi government also has operating at a deficit. The Saudi government is now issuing bonds because they operate at a deficit now, just like the U.S. does. They have such huge infrastructure costs they built in for when they were a wealthy country. They're not a wealthy country now. They have to borrow money to exist.
They learn from us.
Yeah, right, exactly. Good and bad. And I think that could bring in more presence. In other words, if they can get more oil sales doing it in a local currency, they're going to do it. They're not going to worry about their U.S. allegiance. I really believe that. If there's a transaction that makes financial sense, they're going to do it.
Yeah. Yeah, and I don't see that changing. I do think that they'll just kind of say, well, we'll take what we want. It's our assets, and that does start.
They should.
Yeah.
It's their oil. You said it. It's their oil, and oil's a cartel anyway. So the idea that we think oil floats freely, let's acknowledge the cartel implications here. The one that concerns me is the BRICS.
Yeah.
In terms of developing a system that could compete.
There's some good comments coming through here today. Margaret says, who feels safe owning rupees? And you're right. I mean, obviously the rupee is, I believe, at the lowest level in history, if I'm not mistaken. Like actually, let me bring it up here. Let me bring up the rupees for you and show you on a weekly. I'll do an annual chart here of the rupee. This is an annual chart, guys. It goes all the way back into the 70s. Just to make this picture very clear, back in 1970s, you could $1 would buy you 7 rupees. Today it's 84, and that has been a pretty linear chart. There's been some pullbacks here in 2000 to 2008. After that, it's just been nothing but up. So yeah, I wouldn't feel comfortable either. But one thing I think that's interesting is when you look at Saudi Arabia, if they are forced because of the system that's currently in place to be holding U.S. dollars and buying U.S. dollars. That's also a risk to them because now they are predominantly in U.S. dollars, which of course, holding those dollars drives the value of our dollar up, gives us some strength out there. And it was a good question that came in from Steve. He says, if OPEC is buying in other currencies, will the dollar drop? And yeah, because there's no need for them to hold. So before, Indian markets would have to sell the rupees, buy dollars, buy oil. Not the way it works anymore. So that demand, that external demand disappears. And I personally think this is the way the system should be, which is pay with what you want. The person selling the commodity can do whatever they want and accept whatever they want as payment. But if Saudi continues to do this and other countries say, hey, I don't need to sell my gold for dollars, I'll sell it for rubles or drachma, lira, whatever you want to sell me, then that's certainly going to take away some of the power that the U.S. has, which may start to erode our dominant status in the world, but I still think we'll be the world reserve currency. It'll just be more diluted. That's my perspective.
I mirror that completely. I would also, though, like to add one other thing to the great observation you had from one of your listeners saying, well, who wants to own rupees? I would point out risk and reward are commensurate. So yes, you're right. Saudi is getting rupee income now, right? They've got rupee. But when they take those rupees and invest them in the local sovereign market, they're earning over 8% there to compensate for that risk. Whereas if they have dollars, right, and they take those dollars and invest them, the best they're getting here is 4%. So risk and reward are commensurate. Your listener is very right. Owning rupees is more speculative, but the interest rate environment there relative to the dollar is also more attractive to help compensate for that. So the truth is they don't mind owning rupees.
Right. And there's so many other pieces that weave this together. I was looking at a chart earlier, which I don't think I have anymore. I was just clicking through a whole bunch of really cool charts. And there was one that showed the amount of U.S. government bonds held by Japan, they were the biggest one by a wide margin. And you wonder, well, why? Well, because their interest rates were negative 0.1. So you can borrow money at negative 0.1 and you can borrow $1 billion from Japan, then just go buy a government treasury, and you basically make this carry trade for very, very cheap. And now that's unwinding, and that's, of course, we saw that happen earlier this year. But I love how this whole machine works.
Carry trade. Yep, we had decades of that carry trade, right?
Yeah.
That was a no-brainer.
It's interesting when you look at finance, and most people have a hard time just budgeting and keeping their savings account above zero and paying their bills. You don't think about things like that, where it's, hey, I could borrow $1 billion from Japan, buy US dollars, then buy government bonds, make 4%, minus the negative 0.1. I'm making 4.1%, call it almost risk-free, until the carry trade doesn't work anymore. And here we go.
Until the yield relationships between the two countries change.
Ooh, exactly. And that can be painful. It works
until it doesn't.
That's right.
Like anything else, it works until it doesn't.
That is. So, as you go out there and continue to teach for these governments, central banks, brokerage firms around the world, what is one of the big things that's changing for you in your talk track? Because obviously, as an instructor teaching this asset class, you know how it's supposed to work, but I'm sure you're incorporating in some things as this market's definitely shifting. The bond markets are speaking very loudly. How has your talk track changed?
That's a good question, and the answer might surprise you, because the economics really haven't changed. A bond is a bond is a bond. But what is fascinating to me is the correlation, because I'm very fortunate with an international client base, the correlation that goes on between the central banks. And, nothing operates in a vacuum. Everything is connected. And I would even take that back to the Fed was basically forced to drop 25 basis points today because the Bank of England and the European Central Bank did it last week. And there is cohesion
There you go.
between the different central banks. So, seeing the way they operate and the way different things have been adopted by different countries, like QE, I feel very fortunate to have lived through this period we have, where this whole economic mechanism called quantitative easing was introduced. Mm-hmm. And the reality is we still don't know the implications of this. Virtually every country in the world participated in quantitative easing. But we don't really know the impact of dumping all this money into our economies is going to be on a longer term basis.
Yeah.
So how the different economies are managing it. Mexico is living under an austerity program. They want to hoard everything they've got because they're worried it's going to go away. Versus, as here in the U.S., we tend to encourage the more consumption model, or your more manufacturing model. So, understanding and starting to see even clearer the dynamics between the different economies really is fascinating. I just like it as an academic exercise. From a risk point of view, though, there are some things that concern me, and that's that the market is getting more sophisticated. Bonds, bonds used to be dull and boring.
Right.
When you get into structured product and asset-backed securities, this market is getting pretty sophisticated. That's in the public market. Then add the private debt market, which is exploding just like the private equity market is. And that's where products get even more esoteric and more sophisticated. I'm worried that we're going to shoot ourselves in the foot again and create products that people don't really understand.
Yeah. And that will happen. There's always some new product being created. Somebody's always the way it works. Indigo asked an interesting question. He says, what does Bill think about the proposal to eliminate the FDIC?
Stupidest proposal I've ever heard. Why?
Don't mince your words. Tell us how you really feel. Come on.
This is a bunch of billionaires who it doesn't matter to coming up with an idea. The FDIC doesn't cost the government a dime. The FDIC is paid for by the banks.
Yeah.
So the investors are getting insurance. It's not costing the taxpayer a dime. Why is this the program you're targeting? It is the stupidest proposal I've ever heard. Now, if the government were footing the bill, then maybe you've got a right to say, okay, in this movement of, cost cutting, let's throw it on the list. But this isn't even a government expenditure.
Yeah.
Absolutely stupidest proposal. I couldn't believe I heard that today.
And I saw Steve here say something really interesting, and this I agree with this statement. He says in bold letters, "Run on the banks." And think about it. If you have money in the bank right now, and you hear that they're going to abolish the safety net mechanism that insures your account from those banks doing wrongdoing, which happens all the time because these guys are trying to make money. I don't know if I'd want to keep my money in a bank. It would cause me to lose faith in the financial system as it stands, the banking system. Yep. I think it's a stupid idea as well.
A run on a bank is a self-fulfilling prophecy.
Yeah.
Right? If people think there's going to be a run on a bank, there's going to be a run on a bank because they're going to act accordingly. And you just increase that risk by taking away the FDIC insurance. And I stress, it's not a government expenditure. Why are they even looking at it?
Yeah, that is really silly. Well, a lot of times these candidates and administrations will throw out some idea that you just go, what in the hell are you thinking? And they're doing it to see what the reaction is, right? Another interesting one, I know you're not a big fan of Bitcoin from the perspective of spending and using it as a currency like the dollar. However, one of the talk tracks that I have in my program for crypto is talking about a strategic asset reserve of Bitcoin for the U.S. government. We have a bunch sitting at the Marshal Service right now that's government owned, and they've been selling that. Maybe they'll keep it. You also have a couple of bills ready to go. Cynthia Loomis has been spearheading that, which says, let's create a strategic Bitcoin reserve for the United States. Trump has also talked about that. What's your take on the U.S. government having a strategic Bitcoin reserve? When would it make a difference?
I'm warming up to the idea. Let me put it that way. My original reaction was why?
Yeah.
But and you know my whole spiel about Bitcoin is not a currency, it's not a coin.
Right.
But I will admit it is an asset.
Yeah.
I mean, by every definition. Just because it's virtual doesn't mean it's not an asset. So to the extent, but my question is, for those people who are advocating this, for what purpose? What is the purpose of creating a strategic Bitcoin reserve?
And I have a hypothesis there. And this actually goes into conspiracy theory. We'll go through the beginning of it, and then we'll dive into the conspiracy theory side, which I think you'll find interesting. So on one hand, what you have is you control the supply of dollars, which is infinite. And you can continue to print and devalue, which they've been doing. And yes, they buy gold as a strategic asset. We've got a gold reserve, etc. With Bitcoin, we know there's only 21 million. And by having it on your balance sheet, basically what they'll start doing is a MicroStrategy, which is I'm going to print dollars for nothing. I'm going to buy Bitcoin and keep it on my asset and on my balance sheet as an asset. So this will go up because of finite supply. And I can keep printing more money and buying more Bitcoin, thus driving the price of Bitcoin even higher. So there's one school of thought
that would make you MicroStrategy, by the way, right?
Right, exactly.
That would make you micro.
Right. That's pretty much this. Oh, I think what they're looking at MicroStrategy going, not a bad model. Here's the issue. MicroStrategy, if there's a run or a major sell-off in Bitcoin, there could be a liquidation point for MicroStrategy, and that company could collapse. And I think personally that could be a black swan event next year. We'll talk about that next year, but I think that may be our black swan event in 2025. I have to remember this date, so when it happens, I can reference the December 18th show when I called this a black swan event. But the government...
But I still have the same question. What is the purpose of having this reserve? Just to make money for the government?
And help, because you have an asset that's appreciating in value exponentially, and therefore you can pay down some of your debts, and you'll pay back with cheaper dollars.
So you have to sell it.
Exactly.
So you have to sell it.
At some point. And then the conspiracy side is this. I heard some social media guys talk about this, and I think this would be an act of war, honestly. But because most central banks now have gold reserves, right? They're holding on to gold and backing their currency with gold. The belief was, well, go ahead.
We don't back our currency. No country backs our currency.
Not backed, excuse me, but has it as yeah, sorry, I said it wrong.
I'm
correct.
sorry.
Yeah.
Okay, go ahead.
No, you're
sorry.
right. You called. I said it wrong. So this conspiracy theory was that we would start to build this Bitcoin reserve, buying more and more Bitcoin, and get our Bitcoin reserve significant enough, and then all at once sell all of our gold on the open market. And this assumes that none of these other governments and central banks held Bitcoin. And the belief would be that it would completely crash those governments, and we'd be holding Bitcoin, which is going up in value. And that's total conspiracy stuff there. But I'm like, it is plausible that you could do that sort of run and manipulation of a market.
Again, if that's the business the government wants to be in, they could do it now with other assets. I mean, I'm not a conspiracy person, so I'm having a hard time.
There you go. No, it's all right. I do think that they're gonna pass this bill with a strategic Bitcoin reserve, and the main reason being that it's going to be something on their balance sheet that will continue to grow with wealth and give us some foothold if other central banks do it. So we've heard the Central Bank of Canada wants to do it as well. I think Argentina and a few other banks are saying we're going to start building a strategic Bitcoin reserve. So it almost becomes this keep up with the Joneses type of marketplace where people are scrambling to get some. And, for me, who holds Bitcoin long term, great, bring it on. I'm more the merrier.
I should ask maybe on behalf of myself, but maybe your audience, we do have a country out there that uses Bitcoin as its currency. How's that working?
It's actually going pretty good.
Is it? I say that open-endedly. Because you don't hear about El Salvador and its efforts with Bitcoin. I haven't heard much about it. Is it really working? And are they building up national reserves of Bitcoin like they would of any other currency, I wonder?
El Salvador they buy a Bitcoin a day, which is not that much. It's, $100,000 a day, but they are buying Bitcoin. They're mining Bitcoin. And I think it's not just the Bitcoin that's helped their economy thrive. It's the fact that if you have a MS-13 tattoo, you just go to prison. There's no judge, jury. Just you're going to this prison. So you clean up a very violent country and make it a peaceful place that's attractive. You're going to bring a lot more money in tourism. You open the door to digital companies and say, hey, we'll give you incentives to build your crypto products here in our country. I think that brings in more business and big money. From what I've seen, it's actually been very successful. And I think it's interesting because other governments around the world are certainly watching this, right? They're watching what's going on with El Salvador as this little petri dish of Bitcoin. And if it does work out, I envision other countries which may be more advanced starting to adopt some similar policies.
I wouldn't disagree. That's what I say. I was really an open-ended question. I know that they wanted to issue Bitcoin-denominated sovereign debt, and they weren't able to do that. That they just couldn't find enough buyers.
Bitcoin bonds.
But yeah.
And that may change.
I'm glad to hear it's working.
Yeah, we'll see it over time. We shall see.
We shall see.
All right. Go ahead.
Go ahead.
No, you first.
I was just going to say, relative to the Fed meeting.
Yeah.
The question always becomes, what's for January, and I just want to reiterate, we are now as data determinant as I have ever seen. Talk about living CPI or PCE number to PCE number. I mean, even things this week like capacity utilization, which is not a number many people look at. When it was slightly weaker, it really did impact the market a little bit. So, I get a little bit upset with the talking heads on TV who tend to microanalyze everything. I warn everybody, it's going to get worse before it gets better. As we try and figure out what the next step of the Fed is. I mean, there's even a directional difference. Some people are already talking about hikes.
Yeah.
So we've got, reduction, status quo, hikes, any number of scenarios. That's going to make us even more data dependent. So if the data focus has been bothering you like it has me as of late, it's only going to get worse. It really is.
Yeah. Well, the thing that bothers me, it's this chart right here, and it's a dot plot. Where to have it? I had the dot plot on here. There it is. I love that they've got forecast out to 2027. Like, come on, man. No one even has a clue what's going to happen by the end of next year. Maybe even the end of this year, things could be wildly different. So to come up with a hypothesis about the next 4 years and 3 years out is just ridiculous to me. It's just totally stupid, but whatever.
Doesn't this take transparency to an absurd level? That's what I was saying at the beginning. This is an illustration of, I think it's just absurd transparency. Nobody can make an accurate prediction for 3 years. Even a Fed member, I'm sorry.
I don't even know if I would call it transparency. I mean, this is all opinion. This is not rooted in fact, and there might be some trends that you can glean from it. Oh, unemployment and GDP numbers, but I mean, especially when you have a brand new administration coming in, making aggressive changes across the board, and you've got your Doge, Elon Musk, and Vivek Ramaswamy making some big changes. Oof. I would not want to be an economist in this time because so many factors could change here. It's just wild.
Absolutely agree. Which is why for anybody to say they know what's going to happen next year, they're just wrong. I'm sorry. Your ego is ahead of your intellect.
And I always say that too. It's like, look, I don't know what next year's going to hold. I have my opinions. We do a thing every January on this program, which is, what do you think the price of the S&P 500 will be at the end of the year? I mean, I'm way off. I thought we'd be up 7% on the year because that's historical average during an election year, and here we are kissing 30. So. We're not done yet. We could fall a bit, but I doubt we're going to be at 7% by the end of the year. So.
I doubt it. If we do, something big hit the fan.
Some doo-doo in a big way. All right, talk to me about your teaching schedule. I know you are doing the Canary in the Coal Mine series for Trading Academy. How's that going, and when is it?
Going great. We've got the Focus series, exactly as you said. We just had one this week. So we had our last one for the week. There's going to be one scheduled for February. It's not on the calendar yet. The next thing on the calendar is January 29th. I'll do another XLT, and I'm going to follow up with the convertible bond market. I did an XLT that some people might have seen, and we talked about those micro-strategy bonds, the convertibles, and the fact, what are the benefits and how they work, where you got a bond that gives you some upside equity exposure. And MicroStrategies has really resuscitated this convert market, which has been around for decades,
Yeah.
but it's really going through a resurgence. We've got some other big names coming into the market. So I get a chance to talk about the equity market a little bit. So I can already guarantee you on that January 29th class, I'll be talking more about the convertible bond market. I do warn people, a lot of people are asking me about the MicroStrategy bonds. I do warn everyone, they are private placements. They did 3 offerings this year.
Yeah.
None of them were public offerings, so they're not available to the retail investor yet. But who's the chairman of Michael Saylor?
Mike Saylor,
Indicated they want to do at least 4 rounds next year
Yeah.
of additional bond offerings, and they're probably going to be reaching out to the retail investor. So next year, we should have an opportunity to participate in these bonds.
And they are interesting, a 0 coupon convertible bond. It sounds so crazy. You're like, wait a minute, isn't the whole point of a bond that I get a predictable stream of income payments? That's what it's supposed to be. And here you have a convertible one. I'll leave you to that XLT session to talk about that convertibility.
Yeah, but let me remind you, Merlin, what you and I just lived through. Didn't 30% of the world's government bonds have negative interest rates just recently in our lifetime?
Yeah.
0 is better than negative. Who would buy a government bond at a negative interest rate? Yet 30% of the world's bonds were negative during the pandemic.
Somebody was doing it.
Somebody was doing it, so 0 is better than negative.
I'd take my money and hide it under a mattress as opposed to pay to have to lose it.
I'm with you on that.
And then you got your Amherst Financial. It's actually, I had the URL up there. It's aftraining.co. That's his website out there. He's got media and he's got his bookstore. So if you go to shop, we've talked about these books quite a bit. Either $15 a pop, but he's got a special. Buy all 3 for $25. So if you buy 2 of them, you're kind of foolish. You should just buy 3 because it's $25 for all 3.
Third is free. And you've got YouTube's up. I've got YouTube's up there of Merlin and I having discussions about bonds. So they're entertaining.
Good stuff. Those are up there, huh? All right.
Yeah, I think so. It's been a while since I looked at them.
Exactly. I like the
Back
videos.
in the days of stagflation when we were first introducing what an inverted yield curve is to the audience.
Yeah, and now we're out of it. We got to make some new ones, man. We can have some new videos.
That's it. Cool.
All right. Well, hey, let me know when you get out here. I'm still waiting for you. As Big Eb chatted earlier, you do owe me a few beers.
I owe you 3 beers. Yep, I got to pay up soon. I agree.
I'll
get out there soon.
I mean, pretty soon it'll be a keg.
That wouldn't be bad either.
No, either way. All right, Bill. Hey, thank you. I appreciate you coming on and giving some clarity to the bond markets. As always, we do appreciate you, and thank you so much.
Your people are great. Always great working with you, Merlin. Thank you. Have a great holiday, everyone. Be
You
well.
too. Take care.
You too, sir. Thank you.
Yeah, that was Bill Addiss. You can find out more information about his Canary in a Coal Mine bond series by visiting tradingacademy.com and or talk to your enrollment specialist to get more information on that one. How much time I got? Ooh, man. I will quickly go through these markets. I don't want to do a full 1-hour show. We have seen quite a bit of movement in that crypto space, as you can tell here. One day gave back 4 days worth of gains in Bitcoin. The good news is the future's still stuck above 100,000. Ideally, you'd like to see it stay above that 100,000 mark just from a retracement perspective and psychological perspective. I had drawn out on one of the Bitcoin price charts here. Let me bring it up for you guys so we can see it. No, it wasn't this one. It was, somehow all my lines disappeared. Maybe it was my computer downstairs. But we had drawn, a breakout and shown that, typically when you get a breakout, there's that retest of it, which this may be that retest. I was mentioning in my session this morning that I do believe that a weak dollar and higher inflation drive Bitcoin higher. I think it's one of those pieces where if we do have inflation, let's go to something that might inflate higher than the rate of inflation, and that would be Bitcoin. Today, we didn't see that. Market says buying opportunities galore in Bitcoin or in crypto. Yeah, we may not be out of the woods yet. I certainly would wait a little bit here to see how far back the pullback is, but you're looking at a lot of pretty big down numbers here. I mean, I've got double digits. Well, Pet Bitcoin, who cares? But Litecoin down double digits, EOS, Kronos, Ape, Live Peer. So definitely some pain in our markets over the past 24 hours. But the equity markets, how does that look? We talked about that S&P. It looks awful on a one candle perspective, but on the big picture, it's a pullback, man. No big deal. I would be eyeballing this 5,900 mark on the S&P, which means another 40 points lower. We'll see how tomorrow's activity goes. Do we stabilize or does panic start to set in a bit more? We were down 3% on the S&P today, 3.64 on the NASDAQ 100, which is one of your worst performing from the index perspectives. Gold was also selling off today, which it recouped. It was a nice big red candle, then came right back at the end, only down 0.33 on the day. And then surging dollar, well, Crude oil prices up 0.53%. We still are stuck in this narrow, well, not narrow, it's still $6 range, so it's about an 8% sway here. Did you just hope it is? No, I did yesterday on MicroStrategy and SMCI, and we'll see how those pan out. I've got I had the 340s for MicroStrategy expiring Friday. I do have the 370s on MicroStrategy, which is probably going to get exercised tomorrow. Let's go look at MSTR. Yeah, those will probably get exercised on Friday. We'll see. Anything can happen, but the premium on MicroStrategy was just insane. I could have sold the 280s. There's a 280. I could have sold those 280s right here, expiring next Friday, and collected 1%. I mean, just the premium on MicroStrategy is insane right now. But, if this is a Ponzi scheme and blows up, it could be pretty bad. And then SMCI, which had a pretty ugly day today too. I have the 32 strikes expiring Friday, so I'm underwater on those right now, but the premium I collected was fantastic, so it's okay. Not worried about that yet. So is this a buying opportunity in equities? I don't think so, Steve. I would actually wait. This is certainly one of those climactic moments. We could add volume on here, and you can see that the pain level is higher than normal. A lot of activity going on today. Typically, when it's a climactic volume spike, I like to see a much bigger spike of volume, but obviously, there was a pain point today, and people freaking out. Not quite sure if we're out of the woods yet. We still have other central banks to report. Japan's going to be coming out with their rate announcement here shortly. It's tentative, so hopefully they'll come out with it soon. You could try to catch that falling knife. If you're looking at the S&P 500, I think, again, 5,900 is probably a decent spot for it if you're looking at the overall trend continuing to the upside. If not, you're looking at about 5,740 will be your next big level down there, which is the more important one in my opinion. How much lower is that from current price? You're looking at a decline to get there of roughly 3.3%. So I personally would not be looking to buy right now. I would literally be looking for a little bit more of a sell-off, maybe down to that 5740 mark on the S&P. NASDAQ, similar picture. You don't have as clear demand zones, but I'd be looking somewhere on that 24,450 mark. So you could be aggressive. I would personally just wait and not take too big of a chance. All right, let's go into your economic calendar. Obviously, I mentioned we have Japan reporting their rates tonight, and then tomorrow you have the British pound will be coming out with their rate announcement. Right now, expectations are that they're going to stay the same, which would be, I don't know. I'm kind of of opinion that they might cut 25 basis points, but right now the market is pricing in no rate cut there. We have our GDP numbers coming out for the U.S. 1 hour before the equity markets open. You've got Philly Fed Manufacturing Index, unemployment claims, existing home sales, natural gas storage, TIC long-term purchases, a ton of big stuff happening tomorrow for the U.S. equity markets. And on the earnings front, I do have some, this is going to take me an hour show. Dab nabbit, it's going to take me to an hour. I've got it's like 20 seconds left to get out underneath a 1 hour show. Tomorrow, we had Micron Technologies and General Mills and Lennar report today. Tomorrow, we have Nike reporting. We'll see how that one goes. I have some puts on Nike as well. BlackBerry, FedEx, Accenture, Darden Restaurants, and that is your kind of earnings wrap-up. Oops. There's your earnings wrap-up for tomorrow. I had the wrong chart up there. All right. There will be by Friday when the government shuts down. The government won't shut down by Friday. All right, guys, that's going to do it for me. Hope you enjoyed that one with Bill Addiss. Officially, we're a 1 hour show. Didn't want to do an hour show, but here we are. Hope you guys enjoyed that one. Always love having Bill on the program. If you have something you want me to discuss on tomorrow's program, easy to do. Just email me at tradermerlin@gmail.com or put it down below any of the YouTube videos. I'd be very happy to incorporate that in and make a show out of it. We've got tomorrow's Thursday, Friday, and then I'm going to be gone for a week. I'm just decided to drive up north and spend some time with family all next week. I know, you're like, Merlin, how do you expect us to be consistent and come to your show every day if you're taking all this time off? I usually do right around the holidays. It's usually a much lighter period of time. I'm still going to be trading while I'm up there, but I'm not going to have all my resources to do a show. I may jump in to do a short little special for you, but I won't have any of my big equipment here to do a nice production, so I probably won't do it. But anyway, we'll talk to you guys Thursday, Friday. If you got something you want me to cover, let me know. Send it on in, tradermerlin@gmail.com. That's it. Have a fantastic remainder of your day. Be careful that Japanese yen reporting here soon. I'll see you tomorrow.